Hi, welcome to Golden Arch Investing. My name is Liam, and in today's video, we're going to be talking all about Enbridge's 2025 financial guidance. It's a document they released this morning talking all about what they expect to see in 2025. And as somebody who has invested in this stock, who's talked about it here on the channel a couple of times, I think there's a lot of really interesting information in this release that we can use as investors to help us make really good decisions about our Enbridge positions. So I'm going to break this down for you. I'm going to give my thoughts. I'm going to explain kind of what they're talking about, what they're expecting to see in 2025. Then we're going to talk about what I think of the stock, where I think it's going. And I have this up on the screen right in front of me here. We see this is the investor relations post they have here. It is the slides directly from their presentation. Let's start off just talking about the big sort of headline numbers here. So they're expecting their adjusted EBITDA, which is the earnings before depreciation, taxation, interest, taxation, depreciation, amortization. Always have to remind myself what that acronym stands for. But their adjusted EBITDA is going up 9% from the midpoint of last year's guidance. So that means they're expecting 9% more than they expected in the middle of their range last year. Midpoints are always a great way to sort of estimate, because most companies will give a range and say, yeah, we're kind of in this sort of area. You pick the midpoint, you're more likely than not to be close. But they're saying they're going up about 9%, which is awesome to see. High single digits for an oil company is pretty good. Distributable cash flow, DCF per share, they're expecting to only go up 4%. We'll talk about why that's so much lower. They go through that in a slide later, actually. And one thing that's important for me, I'm looking at this dividend per share going up by 3%. When I see the DCF going up by more than the dividend per share, it actually makes me happy, because it shows me that they're not just going to grow the dividend for the sake of growing the dividend. They're only growing the dividend by the amount or less than they're getting extra. So if they're not growing their cash flows, they're not going to grow their dividend. And this company, I believe, will continue to grow their cash flows. That shows me they still have room to grow. They're still planning on reinvesting. They're not just paying out this dividend to keep investors from selling. So a couple things. We go through a couple key points in the EBITDA guidance here. A couple things they talk about that I think are really interesting, that I think kind of tell us about where this company's going. And I specifically want to jump basically past everything here down to the gas distribution and storage section, where they talk about the fact that they have a full year expected now for the US gas utilities, and they have increasing customer acquisitions and rate escalation in Ontario. So Enbridge likes to say, hey, we have this utility-like balance sheet. Don't worry about volatility. We're basically a utility. Seeing their actual utilities they own increasing in value, continuing to return cash flow to the company. Thumbs up there. Renewable power, they're looking at increased contributions from their North American solar and their European Union offshore wind programs. Love it as well. One of the things I've heard actually about renewable energy, you should think about it like a bond. They make this big upfront payment. They're expecting to get it back over a long period of time. Seeing them increasing what they're getting back year by year is awesome. It gives this company a little bit of a wider base to stand on. They're less dependent on a single commodity. Speaking of that single commodity, though, hard to ignore the top number there. Their liquids pipelines. One of the things they're saying, higher utilization across their systems, secured growth projects, all sorts of stuff that they expect to continue growing in 2025 versus 2024. Now, I mentioned earlier, their distributable cash flows are not going up by the same amount. Their DCF is not going up the way they expected it to, or maybe we would want it to when we look at EBITDA going up so much. Here's a couple of reasons. Big one here, financing costs. It's the tale of the 2020s, apparently, right? Oh, these interest rates. I want us to remember that it's 2024, not 2022 right now. And so while, yes, financing costs are higher than they were 5 years ago, objectively, that isn't going to last for too much longer. Yeah, we got another year or two of financing costs still being higher, but depending on the sort of range of these different debt instruments, right? So depending when they took them out and when they're mature, we're probably going to start looking at these costs decreasing, not increasing, in the next 2 years. So love to see that. They acknowledge the financing costs. They acknowledge also like higher earnings and tax legislation. They talk about expending a little bit more money because they bought those US utilities, all sorts of stuff, pretty normal. Next sheet, love it here. This slide, 2025 planning parameters. It's like their risk management slide. And assumptions, super valuable to me, because this tells me the things they're assuming to make these projections. And if I don't believe it, if I don't think they're going to get hit what they're saying, well, then this is where I'd notice. A couple things here. They're expecting high utilization, solid system optimization, embedded revenue growth to net them $200 to $300 million in cost savings. That's a huge number. Do I believe they can do it? If things go right, yes. Takes things going right. They're expecting 3 MMBPD through the main line. Sure. Right? I believe that. Secured project capital, they're expecting only to spend the $6 billion they've sort of earmarked for this year. I'd hope they only spend that money. But it's not unreasonable if something great comes along that they jump. Wouldn't blame management for doing that, right? If somebody was offering a crazy discount, you would take it too in real life. Foreign exchange rates, they're assuming the Canadian dollar is going to sit at about 1.35 Canadian dollars to the US dollar. I hope so. I hope it doesn't get worse than that, but it might. And then they mentioned some sensitivities. They're sensitive to foreign exchange, being a Canadian company, obviously, and they're sensitive to floating interest rates. Again, 2024, we're looking at 2025 here. I think that might not be as big a challenge as we have had it be in the last couple of years, but there's always the potential. There's always the potential that interest rates go back up, and we're looking at a really tough 2025. Funding plan. The one big thing I think investors want to see here, their internal cash flows far exceed their dividend payments. Their dividend payment, they're saying it's like $8-ish billion, and that they're cash flowing $14-ish billion. You know, there's $6 billion there, that right? That $8 billion is like 60% range. So don't hate seeing that. Looking at them, they're continuing to fund using debt, but they're also securing capital, securing growth, right? They have to do this stuff. And I assume this debt is going to be cheaper in the not so distant future. So that's basically the end of the slides here. See their contact information for their VP Investor Relations. But I really want to get into a couple of things. Number one, Enbridge is sitting, today is Tuesday, the 3rd of December. Enbridge is sitting at $60-ish a share. Now, the last time Enbridge was in the 60s range for a period of time was that 2014-2015 peak, which is when these Canadian oil and gas stocks were flying. You know, everything was great. Oil was quite expensive per barrel. And so oil producers were having a great time. It didn't last. These all came crashing down. It's taken us 10-ish years to get back to about the same range, right? Let's say that 2022 was the first time we retouched these levels. Yeah, right? If we're looking at 8 to 10 years of dead money again for the next 10, horrifying return on investment. Do I think that's going to happen? No, and I'll tell you why. It's all about PE. I was looking back through the historical data. 2014, the PE ratio was in like 45 range. Today we're in the 20 range. And I don't mean 20s like 20 through 29. I mean like 20 point something range. So yes, that's expensive compared to historical data for the last year or two, but it's significantly cheaper than it has been. And I think they've done a good job of growing into their valuation. So they've been able to grow. They're growing at high single digits. This is not a new company, right? Like a serious legacy behemoth in an industry like oil and gas that I don't know that many of us think of as this huge growth industry in these 2020s. Growing at high single digits is impressive. And so growing into their valuation has made it much more reasonable for them to have that kind of valuation, to be worth the kind of money they're worth now, to be in this kind of range. Just my thoughts, obviously, but I think that we're hopefully not in the same position we were last time that everything came crashing down. Now, that doesn't mean that I think we're going to double from here. Don't take that as being like, well, okay, if we're at a 20 now and we were at a 45 before, we must double. No, there's no reason actually for this stock to double in any sort of reasonable time frame, right? Maybe not for the next 10 full years for this stock to double. But that's not the goal of a company like this. We're not investing in this to get rich quick. This is all about slow compounding. And I think they've done that really well. Now, do I think they're going to hit all these numbers? I think is probably the most important question that most of you clicked on this video for. That's a great question. Now, I believe Enbridge probably knows a lot more than the average person. As a whole company, they know a lot more than the average person about what exactly is going to happen in 2025 when we're talking politically, we're talking sort of the economics of it all. They're so tied into that Gulf Coast refinery industry, as well as obviously the Canadian extraction industry. They are literally the main line between these two huge centers of industry for our respective countries. I think if they were expecting things to go wrong in 2025, they would probably be working on cutting expenses or, maybe canceling projects or selling assets now. And they're not. So I think they are not entirely worried, or as worried as the media are, about the potential of tariffs or whatever, right? Of a trade war between the US and Canada. They don't seem to be worried about that. They haven't even put that in their risk factors, right? They didn't even mention that. They mentioned the currency, which is fair, right? They mentioned the fact that the currency might be dropping and that could be a problem, but they didn't mention anything about tariffs on their products, and they would be the ones paying. Well, you know what I mean. They would be the ones at least suffering for bringing the stuff across the border. So I don't think they're too worried about it. Now, I think that there's definitely potential for things to be a little bit choppy. I think you should be expecting volatility in the next year. I think you should be expecting, honestly, for this company to go nowhere for a year. And by go nowhere, I mean it might go up 5%, down 5%, up 10, down 10, up 15, down 15, 20, 20. But I think we're going to kind of yo-yo. And we might end up going like rocketing higher if things don't end up as tense as they've been advertised. But I think we're probably going to be in a period of volatility. But as long as they execute the way they've sort of outlined, there's no reason for this stock not to be up another 10, 20, 30% when all is said and done at the end of the next year. And I think it'll be up significantly more in the long term. I think this is still a long-term play. These Canadian energy companies, they really do have a pretty unique position, and they have been sort of beaten down by the idea that they're in a dead industry. There's no reason to invest in them anymore. There's no growth there anymore. Man, I think they're still here. I think they're still here to play. I really do. And that's just about all I have for you guys today. If you made it this far in the video, please leave a like, subscribe to the channel. Talk about investing in Canada every week on this channel. It would mean a massive amount to me. And with all that being said, I hope I see you in the next video.